Hey there everyone, today I will be speaking to you about cash control. We will be specifically looking at petty cash. Now I know that you are all super excited to jump into it and find out how it all works, but first we must understand what petty cash is. Petty cash is a small amount of money that a business keeps on hand in order to pay for minor expenses such as pens, papers and other supplies. The process of establishing a petty cash fund involves the three following activities. 1. Establishing the fund. 2. Making payments from the fund. And 3. Replenishing the fund. So first, we must understand the concept of establishing a petty cash fund. The petty cash fund is established by writing a check for the amount of the fund, then cashing the check and placing it under the care of an employee. A journal entry must then be made to record the establishment of the fund. The example in the slide shows that petty cash is debited $100 and cash is credited $100 to record this transaction. So now that we have the first one down pat, it is time we introduce the second, making payments from the fund. During this period of petty cash fund, payments will be made. These payments are usually made in one of two ways. 1. Cash can be directly taken from the fund to make a payment, or 2. Employees seek reimbursement from the fund for payments they have personally made. To put these two methods into practice, an employee could either take the money directly out of the petty cash fund to buy stationery or supplies, or an employee could use their personal money to buy supplies and be later reimbursed. However, for any payment method, a receipt will be necessary. There is a golden rule of petty cash that you must remember. As payments are made from petty cash, no journal entries are made. Journal entries are recorded only when the fund is replenished. Now it is finally time to replenish the fund, which is the final component of the petty cash fund. As the money in the fund decreases, the business must replenish this fund. To do this, the business will first record all of the accumulated expenses made throughout the period of the petty cash fund, which is displayed in the example on this slide. Once all expenses have been accounted for, the business will then write and cash a check for the amount that brings the total cash in the fund back to its original balance. However, there will be certain circumstances where payments cannot be accounted for. For example, if a receipt has not been obtained. This will result in a discrepancy between the cash needed for replenishment and the amount of receipts. This will then be charged to an account called cash over and cash short, which is a temporary account that can have either a debit or credit balance. In this case, the cash requested to replenish the fund is $87, however, the total amount of the receipts is $85, so therefore the business is in cash short and $2 will be needed to be debited as cash short so the account can balance. I really hope that you guys enjoyed this short video and it gave you a good understanding of what petty cash fund is. Thank you so much for watching.